Okay, in part two, we're going to continue talking about some capital budgeting techniques. So let's continue with the next one, which is what's referred to as the Profitability Index. Now, the Profitability Index and the net present value calculation are very similar. They all work off of this basic idea here, where if the value of an asset, that is its benefit, if it's greater than or equal to its price, you would want to buy it. So in net present value context, if the net present value is greater than zero, it means cost is less than benefit. In this case, what Profitability Index does is it divides the two. So you take the benefit and divide it by cost. If that's greater than or equal to 1, then you'd be willing to buy the assets. So when companies are looking for investment opportunities, they would like to find assets or investments that have profitability indexes that are greater than 1.0. Even though the net present value and the profitability index are similar, if they're independent projects, they'll give the exact same answer. They'll both accept or they'll both reject. However, they may not necessarily rank projects in the same way. So the ranking issue is a bit of a problem with the profitability index. So the advantages, it's closely related to NPV. It's easy to understand, communicate. It's very useful in capital rationing if you have to make decisions between one or two investments. And essentially, as I mentioned, the downside is, it has some issues with rankings, that it may conflict with the way net present value ranks the values and the wealth creation of projects. So here we see project A, 1.264. For project B, 1.243. So again, very, very close in profitability index. A is obviously better, slightly higher cost-benefit ratio, if you will. So again, that concept is very clear, that net present value is a concept that really has its fingers in, if you will, or its clenches into the investment mechanism, trying to decide which projects to do and which projects not to do. Now, there is something out there that's called economic value added, and it's not in your textbook, at least not to any greatest extent. And I think it just briefly, we need to mention it because I think a lot of companies are really starting to use this concept of EVA in how they evaluate projects and how they ultimately determine bonuses and compensation for some employers. So economic value added, again, is a method that in the end measures the pure economic profit of a company. That's the profit it has above and beyond the normal rate of return for a business. So if a company has $1 million up front for a project, but after that, it's going to generate inflows each year into perpetuity of $120,000. If the firm's cost of capital is 10%, then what is the net present value in the EVA? Well, the net present value is $200. So we're going to say essentially that we're going to increase the wealth of the company by $200,000. But when you compare the cost of the actual inflows, the benefit of the project, to ultimately the cash, the cost of doing the project, 10% of $1 million is this $100,000. The actual pure economic profit is only $20,000. So we'll give us a picture, if you will, of a more pure form of value that's added to the company. The internal rate of return is a widely used technique in practice. It's very intuitive. It uses percentages, but there's problems with using percentages that we'll talk about when we get there. It uses all the cash flows. It's independent of interest rates. So it provides us with a decent criterion. Again, it's the discount rate that equates net present value equal to 0. So if where net present value would be equal to 0, that's the discount rate, that's the internal rate of return. It's the interest rate that the firm will earn if it invests in the project and it actually gets all of these cash flows. So if its expected return, or its internal rate of return, is greater than or equal to its required return, and in this case its required return is something called WACC. WACC is the weighted average cost of capital. That's essentially the cost of financing. So if you get a higher rate of return from the project than it costs to finance the project, then you should do the project. And again, as we can see here, the discount rate for the project is 10%. So project A is 19.8, project B is 21%. So you can see they're obviously what? They're both greater than 10, so they're both good projects. However, project B has a higher rate of return than project A. So again, let's kind of think back on where we went. B is 21%, A is 19.9%. But that conflicts with the way net present value ranked them. Again, these conflicts, they're not unusual. There's no guarantee that net present value and internal rate of return will ever rank projects in the same order. However, both methods should reach the same conclusion about acceptability. The projects will be good or they'll be bad. Both will agree on that. But their order of priority as far as doing projects is different. And that's where the challenge comes with using the internal rate of return. It accounts for time value, looks at risk, provides doesn't really provide an indication about an increase in value, although indirectly, if it's an acceptable project, the value of the company should go up. It does permit project ranking, but again, it's going to rank things in a different order, if you will. So what's the issue with this? Well, the advantages are executives really like it, right? It's easy to communicate. If the internal rate of return's high enough, you might not even have to estimate any other numbers, required returns. It uses cash flows, time value of money, provides an indication of the riskiness of the project. The higher the return, more likely the greater the risk of the project. The challenge, though, is that it has multiple answers. It's difficult to rank mutually exclusive projects. And the way it determines, it's actually more with the mathematics and the quantification of the number that creates some assumption challenges. And we'll talk a little bit about those here in a couple of minutes. But let's talk about percentages before we get there, because percentages are a problem. So I pose this question to you. If you would like to get 10%, you would like to make an investment, you'd like to get 10%. Would you rather get 10% on $1,000 or 10% on $1 million? Both 10% are acceptable. They're both the same numbers. They're equal to a certain extent. However, I'm sure you'd rather get 10% of $1 million than 10% of $1,000. All right, you have to incorporate the percentage of what question whenever you use percentages, because it clouds the issue, if you will. So let's talk about how these things are related. There is a graph that we can create, and you can do this on the spreadsheet. You'll see, again, let me just pick it up real quick, and you'll see right where it's at. It's called right here, it's the net present value profile. There's a video on how to do this, what it means, how to read it, how to set up the table so that you can understand what it's doing. Those tables are all that, the video's available. And we want to try to look at these two projects, A and B, and try to analyze the graph, see what it tells us. So here are the net present value profiles. Here are the numbers, the net present values. And what net present value profile says is, at 3% discount rate, what is the value, net present value of A and the net present value of B? A is $22,000, B is $20,000. So we're down on this end. A is better than B. But when you go down here to 17%, right, the net present value of A is 33 and B is 42. So now we're down in this range, and you can see now that the blue project is better than the red project. For certain values, these things will agree with each other. But at other values, there is absolutely a difference in the value that's going to be brought to the company. These conflicts are caused by lots of reasons. And we're really not going to talk about them in a lot of detail. We have a couple of slides, but we're not going to talk about them in a lot of detail. Primarily, the reason for the differences is reinvestment. What is the assumption in the technique for how future cash flows are reinvested? Net present value assumes correctly that you always would want to reinvest at least at the company's cost of capital. However, the internal rate of return assumes that things are always going to be reinvested at the internal rate of return. So going back to our projects, right, 10% is the cost of capital. You could probably find other projects that will get at least 10%. You found these two, one was 19 and one was 21%. But the internal rate of return assumes that both of these projects can be reinvested and earn respectively 19 and 21% on all future cash flows. And for really good projects, that might be difficult to understand. Again, we had talked about timing. When cash flows come in the project, we had an example where one project had a big cash flow up sooner, the other project was down 2 or 3 years. They basically had the same kinds of cash flows, but they came in different orders. That will obviously affect net present value and the internal rate of return. So the differences in timing, right, doesn't affect the ranking provided by the internal rate of return, but it does affect the ranking on net present value. The scale, the size of the project is ultimately going to have an impact. The internal rate of return approach is going to favor small projects with high returns. Net present value favors investment that takes the investor the most money. The most expensive projects are going to do better than the least expensive projects. So again, there are basically fundamental differences. On a purely theoretical basis, net present value is the better approach because it measures how much wealth a project creates. It uses the proper reinvestment assumption for cash flows. Despite its superiority, though, financial managers prefer to use the internal rate of return just as often as net present value. Now, finishing up the chapter, we do have one more technique to talk about that's called the modified internal rate of return. And essentially what this does is it controls for some of the problems of the internal rate of return. It allows us to actually do calculations on internal rates of return or on projects where the cash flows are unusual or are what was referred to as being abnormal. So what we ultimately have is we have a project where you invest $60 and that project is going to create some cash flows. The question is, we want to know what the present value of the cash flows were, and we want to know what the terminal value is. What is the future value of those cash flows? So in the end, from this technique, the way the technique works, it looks at the investment as a present value investment. It looks at the reinvested cash flows over time, being the time value of the inflows, right, or the future value. In this case, it would be n equals 2. Then you just solve a very simple time value question for the problem. So the modified internal rate of return correctly assumes reinvestment at opportunity costs. It avoids multiple kinds of IRA issues and problems. Managers like rates of return comparisons, so MIRR is better than the internal rate of return for that reason. So what methods do companies typically use? A recent survey was done Most popular approaches by far were internal rate of return and net present value, right? The payback approach really was only significant as far as a technique to be used when we talked about very small companies. So that's the end of the chapter on capital budgeting.